So with my first car, I settled it in under 4 years. So I think it was around 3 years, while the loan term was for 5 years. So I was actually very, very proud of myself not to be having any debt commitment when it came to my car. But a couple of months after that, I went and took out another loan to buy another car. So hi guys, I'm XIREN and welcome to my channel. So I am a chartered accountant by profession. So today I'll be giving you some tips on how you can be settling your car loan much earlier. Because what are the advantages of settling your car loan earlier? The first advantage is that you do save on interest, and the second advantage is that you do free up your money for other things, for other commitments. And then number three, it just feels good knowing that this particular thing, it does belong to you. This particular asset, it is entirely yours to use as you please without any restrictions if you have fully paid for it. So when it comes to settling your auto loan or your car earlier, there is a couple of terms to know. So first of all, it's their interest rate. So you know that when you did purchase the car, or when you are going to purchase the car, they will be charging you interest. So interest is the money that you are going to pay above that principal or above that capital that the bank would have paid towards the car. So that's how they make their money. So the reason why you want to be settling your car earlier is so that you can save on the interest. So secondly, it's important to know that there's something called an amortization table. So now when they are going to be calculating the installment that you are going to be paying per month, an amortization table, it takes into account that interest rate that you are going to receive. So it's the one that comes up with the amount that you are finally going to pay, the installment amount that you are going to pay each month. And then now you find that that installment amount is divided into your interest, and also it's also divided, a portion of it also goes towards your capital. So your capital, like I've mentioned, is that amount that you would have borrowed in order to be buying that particular car. And a couple of weeks ago, I did a video on how you can choose which structure is right for you, whether you want to be going with the leasing option or an outright purchase, or you want to be financing your car. So for the sake of this example today, it's for when you have financed the car and not when you have leased the car, because you know that if you have leased the car, it means that you have to be returning it back to the dealership, or you have to be now refinancing it. But now when we talk of financing, sometimes when you do go to a dealership to buy the car, they might say that you are getting approved for this particular car and you have to repay it maybe over 5 years, or you will have to be repaying it maybe over 6 years. But sometimes these cars can be so costly, and they might say that there is a balloon payment to it. So the balloon payment is the amount that you will end up paying now at the end of the term. If maybe you had received like 5 years or 6 years, it means that come 6 years later, this is the amount as well, a lump sum that you are going to have to be paying up, or now you are going to have to be refinancing. So it's important to know those concepts, because now if you know about those concepts, you will know how to be settling your loan. You will know if you are paying that particular loan amount so it can reduce the capital balance, or you are paying that additional payment so that it can reduce your balloon payment. So it's important to know those things. But for the sake of our example today, we are just going to be looking at an example which does not have a balloon payment. So we'll look into a car that maybe you bought for like $25,000, and then you got an interest rate of 6%, and then the term that they have given you is over 5 years. So on this example, your monthly installment is going to be $483, and then the total interest that you would have paid over the 5 years or the 60 months is $3,999, while the total monthly payments that you would have made will be $2,800. $8,999, and then interest makes up 14% of that particular amount. And then this is how your annual amortization table is going to look. You can see that in the first year, the interest that you are going to pay is going to be around $1,379, while in year 5, the interest would have reduced to $184 because you are making those monthly payments. So it is reducing that interest payment. And then this is how your monthly amortization table is going to look. So from that installment that you are paying, $125 goes towards the interest in the first month, while $358 goes towards the principal or the capital balance, which reduces your capital balance of $25,000. So every month when you are paying that installment of $483, it is going to be reducing that interest that you are paying, because now more money is going towards the capital balance. It's going towards reducing the capital balance until it finally reaches 0 at the end of year 5. So now coming to making additional payments so that you can quickly pay off your loan. Let's say you are going to be topping up with $100 every single month. This is the result. It's going to reduce your loan term by 9 months, and also you are going to be saving on the interest by $793 by paying that $100 every single month. Now let's say you want to accelerate your payment so you can finish earlier and top it to $200 per month. The effect will be that you are going to save more time. Now you are going to settle your loan in 3 years and 5 months, and the interest rate that you are going to have saved is $1,319. So you can see that paying more towards your loan, it reduces the term of your loan, because why? It is reducing the interest that you are paying. And also you can see if you do increase your additional payments to $300 per month, now you are going to settle your loan in less than 3 years, meaning that you are going to be owning this car or have fully paid for this car in less than 3 years, since it's going to take 2 years 11 months to settle the loan. And also you would have saved interest of $1,695. So let's say maybe you can't make monthly additional payments, but maybe once a year you do get a bonus and you want to put it into your car. So this is the effect. So let's say you are able to put up $3,600 after or in month 12 every single year. Now you are going to be paying off your loan in just 3 years, meaning that you would have saved 2 years, and also you would have saved $1,374. So when you can see, when it comes to settling a car, there's many ways that you can approach it. You can be paying a lump sum, or you can be paying bi-weekly, because if you do also pay bi-weekly, that additional payment, it does save you on your interest. But as you can see, when it comes to a car, you're not really saving as much as when it comes to a house, because the interest component on short-term loans or medium-term loans, it's not as hectic as when you are having that long-term loan like a mortgage bond.